Hello everyone, welcome to a new video on Learn About Stocks. Many people have a question in mind about put options on how they can use these options to make money during market corrections. Okay, so I decided to make the video explaining the basic concept or the basic logic behind the put option contracts which we can trade from on the stock exchanges. So let's begin. Remember that this is just the part one of the video where I'll be explaining the basic concept only. Okay, if you understand the basic concept, it will be easier for you to then understand why the prices keep moving the way they do, depending on how the underlying index or the stock is moving up or down. Okay, so please understand the logic first. This will help you later on when you actually trade in put options. So let's begin now. Since this is my very first video on futures and options, let's have a quick look of what it actually is. Okay, so futures and options are basically derivative products. Okay, so what is derivative products is they derive their value from an underlying asset. So that in case of the stock market, means I will be talking only about the stock market, not the commodities market. So in case of the stock market, the underlying asset can be an index or a stock. Now in case of index, it could be something like Nifty or Bank Nifty or several other indices which many people track on a regular basis. So most of these indices have a futures and options contract available on them for trading. Apart from that, in case of stocks, most of the large blue chip stocks which are actively traded on the stock exchanges and have substantial market cap also, so such stocks also have futures and options contract available for trading on them. Okay, so these can be the underlying assets on the respective futures and options contracts. So the value of these futures and options contract, the prices that we see on being traded on the stock exchanges, are dependent on how the respective index or the respective stock price is moving. Okay, so depending on whether they're moving up or down, the value of the futures and options contract also keeps moving up or down. Now, there is another important point that everybody needs to know is that these futures and options contract have a fixed validity. Now, these are contracts, so these are agreements. So they have a fixed validity and an expiry date. After the expiry date, these futures and options contract do not remain valid. So so you need to be careful of the expiry date as well when you are buying or selling a particular futures or options contract. Okay, so be mindful of this fact. Now let's talk about put option in particular. Basically there are two types of options, call options and put options. So call option is something that helps you benefit in an up move, okay, when the market is moving up. Whereas put option is something that can help you make money when the market is falling down, or it can help protect the value of your portfolio from a sudden market fall. So basically put option is like an insurance policy. Okay, when the market is moving up, most of the stock prices are moving up, our portfolio is also benefiting from it in general. But if there is a sudden market fall, then the value of our portfolio also drops. So to protect us from such an unexpected fall, okay, the put option can be used effectively. So basically, just like how we buy an insurance policy to cover us from an unforeseen event. Okay, so that unforeseen event, we buy insurance, for example, we buy a motor insurance for our car or two-wheeler, then we buy health insurance or we buy life insurance. So most of these insurance policies cover a particular unforeseen event. So it could be a car accident or road accident, it could be any medical emergency, or it could be an unfortunate death of a family member. So these insurance policies basically cover us from such an unforeseen event. So in similar case, the put option can be used to protect us from an unforeseen price correction. Okay, something that might happen all of a sudden. So put option can help us protect against that unforeseen price correction. So this is effectively like an insurance policy. Now, just like in an insurance policy, we pay a premium to get the coverage. In similar case, to buy a put option, we have to pay a premium to so that we get protection from that unforeseen price correction. Now, in case of an insurance policy, we are paying the premium to an insurance company. Okay, but here in case of put option, there is no company involved. There is another trader out there who is selling that put option to us. So when we are buying a put option and paying the premium, the seller is receiving the premium amount, and then he is taking up all the risk of that unforeseen event. Okay, so if that event actually happens, then he will have to compensate us for that. And if that event does not happen, then the seller can keep the premium as his profit. Okay, so you'll understand this more about it when I explain you the working model in one of the upcoming slides. So as for the working model, I'll be considering the Nifty index put options, which are the most popular ones being traded on the stock exchanges. So to understand the concept now, for example, the Nifty is currently trading around the 14,500 mark. So there is an important parameter that we need to consider is the strike price. So put options are available for various strike prices. These strike prices for the Nifty index in particular are available in multiples of 100. So since Nifty is currently trading at 14,500, around 14,500 levels, we can have a look at different strike prices of Nifty put options. They can be something like 14,200, 14,300, like that, and we can go up to even 15,000 or higher levels as well. But all these strike prices are available in multiples of 100. So this is one important parameter that we should consider while checking out the prices of different Nifty index put options. The other important parameter is the expiry date. Okay, so these option contracts are available for weekly as well as monthly expiry dates. Okay, so for weekly contracts, they are basically expiring on the Thursday of that particular week. For example, today is 15th of January. Okay, so the next weekly contract expiry is for the upcoming Thursday, which is 21st of January. The monthly expiry is the last Thursday of that particular month. So the January month expiry contract will expire on the last Thursday, that is the 28th of January. Similarly, weekly contracts are available for almost every week, so every Thursday. Monthly contracts are available for the current month, the next month, and the one after that. Okay, so only for these 3 months the contracts are available for trading. And as one of the months expires, then a new contract is introduced for the far month. Okay. So when January contract will expire, we will all have the option to trade in February, March, and April contracts. Weekly contracts we will always continue with the 1 week being introduced after expiry of every one previous week. Okay, so the strike prices and the expiry date are two important parameters that we should look at very carefully while buying or selling a particular option contract. Now, the premium value that we can see on the stock exchange being traded on a regular basis. So the premium value depends on a few important parameters, okay, few important factors. So please understand these things very carefully. The first most important parameter or the factor is the strike price, and what is the relation of the strike price compared to the current Nifty level. So whether the strike price that we are checking out is below the current Nifty level or above the current Nifty level. This will definitely affect the premium amount being charged or being traded for that particular option contract. The next factor is the expiry date of that option contract. So the farther the expiry date, the higher will be the premium value. Okay, so if the nearest expiry date contract will have the cheapest premium value. So similarly, in case of strike price also, I would like to mention that in case of put options, for example, the higher the strike price, the higher will be the premium value. For example, at current Nifty level of around 14,500, if we check out the January month expiry contract for 14,600 level strike price, okay, then that value will be higher than 14,400 strike price Nifty put option for the same expiry date. So remember this, in case of put option, higher the strike price, higher will be the premium value, lower the strike price, lower will be the premium value. And in case of expiry date, nearer the contract expiry, lower will be the premium value. Farther the contract expiry, means there is if there is a longer duration for expiry, then the premium value for the same strike price will be definitely higher. So these two are very important factors which affect the premium value. Okay. The third important factor is the general mood in the market. Okay, the direction or the general mood in the market. So if the market is going up or the Nifty index is going up, then the put option of any particular strike price will fall. Whereas if the market suddenly makes a U-turn and starts falling, then the put option value will start increasing at a very fast pace as well. Okay, so the general mood and the direction in the market also do affect the value of the premium of those particular put option contracts. Now, in case of the seller of the option, I would like to tell you that since the seller of the option contract receives the premium and he assumes the entire risk of that unforeseen event, he has to provide a sufficient margin to the stock exchanges while during the trade. Okay, since he is assuming a lot of risk, because nobody can predict with confidence that the market will fall or will not fall beyond a particular level or up to a certain level in a particular duration. Nobody can predict this with precision. So there is a huge amount of risk always attached for the seller of the option contract. Hence, that seller has to provide sufficient margin to the stock exchanges. Whereas a buyer of the put option has to pay only the premium amount. Okay, he doesn't have to provide any extra margin for the trade. So the buyer will have the maximum risk of the premium amount that he is paying, nothing further. So if that unforeseen event does not happen, then what is the maximum thing that the buyer of the put option will lose is the premium that he has already paid. But in case of the seller, he has a lot to lose if the unforeseen event actually happens. Okay, so please remember this important point while you trade in a put option. Now let's look at a working model. So for this example, let's assume that the Nifty index is currently at 14,525 level, and Mr. A person who is trading in the stock exchange on regular basis, and he has a substantial portfolio with him. So suppose Mr. A wants to protect himself from a sudden correction in Nifty. So what he does is he purchases one lot of Nifty 14,400 strike price put option. Okay, PE means put option. So one lot, what does one lot mean? So basically one lot of Nifty put option has 75 units in it at this moment. Okay, so this can obviously get altered over a period of time. That depends on how the stock exchanges change the lot size, but at this moment there are the one lot of Nifty comprises of 75 units. So suppose he purchases one lot of Nifty 14,400. So remember, this particular put option is currently below the current Nifty level. Nifty level currently we have assumed it at 14,525. So he is buying a put option for 14,400 strike price for the current month expiry at a price of rupees 80 per unit. Okay, this price is something that is traded on the exchange actively. So somebody has to sell this at 80 rupees for Mr. A to purchase this. Okay, so if now on the day of expiry, okay, this particular trade happened a substantial number of days before the expiry. Now suppose on the day of the expiry, if the Nifty closes anywhere below 14,400 level, then Mr. A will receive the difference between Nifty closing level and 14,400. That is the strike price of his put option. Okay, remember the importance of this strike price you'll understand in this model now. So on the day of the expiry, wherever the Nifty closes below 14,400, that is the strike price, that difference he will receive. Okay, so who is going to pay that difference is basically the seller. The seller of the option contract will have to pay the difference between the strike price and the Nifty closing level, whatever it is, if it is below that strike price. Okay, but if the Nifty closes anywhere above that strike price, anywhere above 14,400 level, then Mr. A will receive nothing, and the entire premium that was paid to the seller will be the seller's profit. Okay, he will have to pay nothing to Mr. A. So this is the importance of the strike price. So since he had purchased 14,400 strike price while the Nifty was actually trading at 14,525, the benefit for Mr. A would have started only below 14,400 and nothing above it. Okay, so now let's assume that on the day of the expiry, the Nifty closed at 14,175. So this level is substantially lower than the Nifty level that was trading at when Mr. A purchased this particular put option. So on the day of expiry, if Nifty closes at this level, what will Mr. A receive? He will receive rupees 225 per unit. Okay, 225 per unit. Remember, he had paid a price of rupees 80 per unit when he had purchased the put option, and on the day of the expiry, since Nifty did correct a substantially portion from that level onwards, okay, so Mr. A will receive 225 per unit. Now this is actually the difference between the strike price of his put option and the Nifty closing level on the expiry date. So this difference is something that Mr. A will receive per unit. Now since he had paid rupees 80 as premium to the seller is now bound to pay 225 rupees back to Mr. A. So the actual loss for the seller will be rupees 145 per unit, which is the difference between the amount that he is paying Mr. A now and the premium that he had received from Mr. A during the first trade. So in this situation, as you can see, that Mr. A has benefited substantially because of the market correction. Okay, from Nifty 14,500 odd level, it fell to 14,175 level, and which went below his strike price of his put option. That is the reason why Mr. A did make money from this particular trade. But if there is a situation where the Nifty did not go below the 14,400 level till the expiry, okay, so if at expiry it closes if even 1 point above this strike price level, then Mr. A would not have received nothing from the trade, okay, from the expiry. So please be careful while you trade in put options. There is a possibility that whatever premium you pay can go to zero if the unforeseen event does not actually happen. So if you do find this video useful, please do share it with your friends as well who do actively trade on the stock exchanges. And if you have any questions in mind, please do share it with me in the comment section. I'll try and answer those questions, and these questions will help me while making the part 2 of this video, where I am planning to explain you with a live trading screen. Okay, so the live trading screen means actually on a trading terminal I am trying to demonstrate how the different prices of put options are available for different strike prices and different expiry levels, expiry dates. So please do share your doubts and difficulties in the comments below, and please don't forget to subscribe to my channel. Thank you.